Know Your Customer, or KYC, is a fundamental process across a number of industries aimed at verifying the identity of clients. KYC is vital for preventing financial crimes like money laundering and terrorist financing. What is KYC? KYC refers to the process by which financial institutions verify the identity of their customers. The goal of KYC is to ensure customers are who they claim to be, assess their suitability, and understand the potential risks of illegal intentions in the business relationship. KYC involves collecting and verifying customer information at the time that a relationship starts with that customer, whether that's account opening, whether it's a gaming relationship, or whether it might be an accountant providing services to a customer. And then from there, it's about periodically updating this information. Why is KYC required? Firstly, there's legislation and regulation that mandates the need for KYC. KYC is mandated by various global regulations and laws to combat money laundering and terrorist financing. Key regulations include the USA Patriot Act, which requires financial institutions in the USA to implement comprehensive AML programs, including KYC procedures. There's the European Union's Fourth Anti-Money Laundering Directive, or 4AMLD, which requires EU member states to enforce strict KYC measures. You've got the Financial Action Task Force, or FATF, which is an international body that sets standards and promotes effective implementation of measures for combating money laundering and terrorist financing. Second, KYC is good risk management practice. KYC helps industries assess and manage the risks associated with customer relationships. By verifying identities and monitoring transactions, organizations can detect suspicious activities early and take appropriate action. Third, it's an essential pillar in preventing financial crime. Implementing robust KYC procedures helps prevent money laundering, fraud, terrorist financing, and other financial crimes. It ensures that the financial system is not being used to hide illicit funds or finance terrorism. And last of all, it helps to protect an organization's reputation. Compliance with KYC regulations protects organizations from legal penalties and reputational damage. Failure to implement effective KYC measures can result in hefty fines and loss of customer trust. What are the components of KYC? You've got Customer Identification Program, or CIP. CIP is the first step in the KYC process. It involves collecting basic information to verify the customer's identity, such as their full name, date of birth, address, and an identification number, such as a social security number or a tax identification number. It's about identifying the customer. Next, you've got Customer Due Diligence, or CDD. CDD involves assessing the risk profile of the customer by gathering additional information. This includes understanding the nature and purpose of the customer's relationship and ensuring the legitimacy of the customer's activities. Key elements of CDD are standard due diligence, or SDD, which is applied to low-risk customers. You've got enhanced due diligence, or EDD, which is applied to high-risk customers requiring more detailed information and scrutiny. Then you've got ongoing monitoring. KYC doesn't end after an account is opened or a relationship is started with a customer. Continuous monitoring of customer transactions and activities is important to detect and report suspicious activity. It's where ongoing due diligence, or ODD, fits into the picture. This includes regularly updating customer information, monitoring transactions against expected patterns, identifying and investigating unusual activities, and last of all, screening against watch lists. Organizations must screen customers against various watch lists to ensure they're not dealing with sanctioned individuals or entities. These watch lists include sanctions lists published by bodies like the United Nations, the US government's Treasury Office of Financial Assets Control, or OFAC, and the EU. Politically exposed persons, or PEPs lists. These are individuals who hold prominent public positions and may pose a higher risk for involvement in corruption or bribery, and it also involves their family members and close associates too. To wrap this up, KYC is a vital process across a number of industries, including the financial services industry, and it's essential for compliance with global regulations, risk management, and the prevention of financial crime. By implementing a robust KYC program and a set of measures, Financial institutions and other organizations can protect themselves from legal and reputational risks while ensuring the integrity of the financial system. Don't forget to like, subscribe, and hit the notification bell so you never miss an update. And don't forget to check out the range of courses I offer that are trusted by organizations around the world, including the US government, EY, Cognizant, Accenture, Tata, and many more. You'll find all the details in the description below. Plus, you can connect with me on LinkedIn, where I share plenty of valuable content. Make sure to check out my other video on what are sanctions and my video on transaction monitoring and financial crime.